Greetings, everybody. Welcome to Liberty Call. Today is Thursday, August 31st, 2023, the last day of August. Can you believe it? Summer's almost over. For those of y'all in the South, you're probably not too sad to see that we're headed towards fall sooner than later, but hope everyone down in the Florida area is doing good. My kids said that they're fine. My older one's hoping there's going to be a lot of roof damages because he's in the mold removal business. So let's keep our fingers crossed that some people had some roof damage and need his expertise. So anyways, I'm glad you're here. Thank you very much. And if it's your first time watching Liberty Call, yeah, I'm talking to you right there in the purple shirt. Yeah, you. Please give me some thumbs up, like, share, subscribes, follows, hit the notification bell so you know when I go live. And not as good of a day. It looks like some of the steam is falling out of the markets. It was, the major indexes here locally or domestically were in the green most of the day. And then the last couple of minutes just went, anyways. All right, well, let's go ahead and jump into the numbers and see how they are today. Dow Jones was down 0.48%, 169 points, closed at 34,721. S&P 500 was down 0.16%, closed at 45,007. NASDAQ up 0.11%, closed at 14,034. The VIX down 2.09% right today. It's currently at 1359. Canada was down 0.19, Brazil was down 1.34, and Mexico down 2.75%. In Europe, Germany, one of the few bright spots, was up 0.35%. The UK down 0.46%, France down 0.65%, the Netherlands down 0.24%, Spain down 0.47%, Italy down 0.29%. Another bright spot, Switzerland up 0.32%, and Portugal down 0.25%. Russian exchanges both in the green, MOEX up 0.48, RTSI up 0.68. And the overnights in Asia, the Nikkei was up 0.74%, Australia up 0.1%, New Zealand up 0.55%. In China, the Shanghai was down 0.55%, the Shenzhen component down 0.61%, China 50 down 0.43%, DJ Shanghai down 0.6%, Hang Seng down 0.49%, and the Taiwan weighted came in up 0.58%. All righty. So, like I said, kind of, I have to wonder if people are kind of sitting around waiting to see what's going to happen. Which way is it going to go? I have my own personal thoughts, but I'm not going to talk about right now. All right. Let's go ahead and get to the market recap. S&P 500 climbs as inflation data fuels interest rate optimism. Yep. I mean, if you've been watching along, you know that the financial journalists, the talking heads on TV, they've all been, hoping and praying that the Fed will lower rates or at least pause. And, they'd really love to go back down to the zero bound, where, interest rates are down at zero, because it makes life very, very easy for big business and the lending industry and things like that. But when the price of lending is zero, that just screws up the economy, down the road. So, and we're dealing with it right now. So, all right. The S&P 500 index increased on Thursday following and this article was written at 2:56 Eastern, so it's a little out of date because the markets fell apart late in the day. On Thursday, following the release of U.S. inflation data that aligned with expectations, reinforcing the belief that the Federal Reserve might halt its tightening of monetary policies. The NASDAQ also climbed to its highest level in 4 weeks due to the Commerce Department's report, which indicated that personal consumption expenditures price index, the central bank's preferred inflation measure, rose by 3.3% in July on an annual basis, in line with projections. The core PCE price index, which excludes volatile food and energy components, also increased by 4.2% year on year in July, aligning with estimates. This data maintained traders' anticipation of a pause in rate hikes during the Fed's September policy meeting, with an 88.5% likelihood and around a 51% probability that rates will remain unchanged in November, as indicated by the CME's group's FedWatch tool. Investors interpreted this data as confirmation of the Fed's responsiveness to economic conditions, with multiple interest rate hikes yielding positive outcomes. The 10-year Treasury notes yield decreased to 4.09%, leading to notable growth in major stocks such as Amazon, Meta Platforms, and Tesla, with gains ranging from 0.8 to 2.1%. Salesforce, a cloud-based software provider, surged by 3.7% due to an optimistic revenue forecast. The company's increased prices and resilient demand contributed to its positive outlook. Tesla was the most traded stock in the S&P 500, experiencing a 0.8% rise in its shares during the session. Weekly jobless claims for the week ending August 26 dropped to 228,000, below the projected 235,000 claims. Although this data was initially supported investor sentiment, it followed a report of weaker than anticipated growth in private payrolls the day before, indicating a soft labor market. While all three primary indices were poised for weekly gains, August was marked by losses, resulting in the S&P 500 and NASDAQ facing their first monthly decline since February. In the stock market, advancing stocks outnumbered falling ones, and both the S&P 500 and NASDAQ recorded new highs. On the other hand, Dollar General experienced a slump of over 12% after reducing its annual same-store sales forecast. Dismal manufacturing data from China impacted U.S.-listed Chinese companies, leading to a 2.2% decline for JD.com and a 1.2% drop for Baidu. All right. So, it's kind of good news, bad news right now, but is what it is. All righty. Next up, U.S. consumer spending accelerates. Declining savings is a red flag. All right. Consumer spending in the U.S. saw its most significant rise in 6 months in July, boosted by increased purchases of both goods and services. However, the gradual decrease in monthly inflation rates has solidified the belief that the Federal Reserve will not adjust interest rates in the coming month. I would bet the other way personally, but I'm a contrarian. Let's see here. The Commerce Department's report, along with other data indicating a surprising drop in initial applications for unemployment benefits last week, has further diminished recession risks for the year. While consumer spending's current pace of growth is unlikely to be sustainable, it remains a key economic driver, accounting for 2/3 of economic activity in the U.S. Experts remain cautious, pointing out that households are utilizing savings built up during the pandemic and that student debt repayments are set to resume soon, potentially placing a strain on consumers' finances. How many people out there have so much student debt that they can't afford to pay the rest of their bills? I mean, come on. Actually, if you pay for college while you're going, you don't even have a bill at the end. It's weird. All right. Although some warning signs are emerging, the overall outlook supports the idea of a soft landing for the economy. Consumer spending increased by 0.8% last month, and even when adjusted for inflation, there was a notable gain of 0.6%. The savings rate dipped to 3.5%, the lowest since November of 22, which could influence consumer spending robustness in the future. Nevertheless, the solid rise in real consumer spending at the beginning of the third quarter has led to economists upgrading their GDP estimates. Inflation, as measured by the Personal Consumption Expenditures Price Index, saw a 0.2% rise last month, matching June's increase. The annual PCE inflation rate stood at 3.3% in July compared to June's 3.0%. Excluding volatile components like food and energy, again, because we never eat or drive, the core PCE price index rose 4.2% year on year in July, slightly above June's 4.1%. Despite the cooling labor market, with job openings at 2.5-year lows in July, conditions remain tight due to employers retaining staff amid the challenges faced during the COVID-19 pandemic. The decline in unemployment benefit claims underscores that while labor markets are relaxing somewhat, the cooling is accompanied by minimal layoffs. Overall, the data suggests that while the economy is facing some challenges, a full-blown recession appears to be less likely in the near term. Really? That's mysteriously. Next article will kind of kick sand in the face of everything we just talked about. All right. Last up comes from Zero Hedge. It's titled, It's Time to Re-Examine Your U.S. Recession Playbook, written by Simon White of Bloomberg Macro Strategists. All right. Let's see what he had to say. The upcoming economic downturn in the U.S. is poised to catch investors off guard due to the distinctive behavior of stocks, bonds, and commodities compared to a regular non-inflationary recession. In a typical recession scenario, stocks and commodities would fall while bonds would rise. However, historical patterns suggest that in inflationary recessions, the surface level nominal returns of stocks mask the actual impact on equity portfolios. Bonds, although experiencing nominal gains, tend to start declining in real terms before the recession begins. In contrast, commodities often rally instead of falling in price. These investment behaviors are guided by heuristics, gosh, that's a tough word to say, which are mental shortcuts that help make sense of complex situations. However, relying on these heuristics without adjusting them to fit the current situation can lead to detrimental investment decisions. The market is currently underestimating the possibility of a recession, with manufacturing, GDP, services, leading economic indicators, and job data indicating a potential downturn. Furthermore, there are signs that inflation might increase again. This suggests that not only is there a near-term recession likely, but it could be accompanied by rising inflation, a combination not seen in decades, since the 70s, and they called that stagflation. Inflationary recessions can be misleading due to money illusion, where the impact on investments is not accurately perceived. Stocks might appear to sell off more in nominal terms during inflationary recessions, but the real impact is often more severe. Bonds, which usually rally during a recession, perform differently in inflationary downturns due to the changing investor preferences for greater certainty. Commodities, which typically fall before a recession due to a commodity shock, can actually rally if the recession turns out to be less severe than expected. To navigate this complex landscape, investors need to understand that the past investment behaviors might not align with the future. Adjusting heuristics to the current economic environment and differentiating between real and nominal returns can help investors make more informed decisions and preserve their wealth effectively. Yep. So the previous article, everything's fine. Yeah, we're gonna have soft landing. Everything looks good. And then this one's like, we're a mess. So I kind of lean towards we're in a more of a mess, as far as probabilities, but that's just my own personal belief system from sitting here and staring at these screens all the time. So, all right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.